Welcome to the Two-Handed Economist with John Diamond, where we look at issues from all the angles. President Truman once asked for a one-handed economist because he wanted someone to help make decisions and to not always say on the other hand. In this podcast, we try to look at every issue from multiple angles in order to reach the best solution to the problems at hand. Today is April 30th, 2025. The Bureau of Economic Analysis has released its latest report on GDP, which outlines GDP growth in the first quarter of this year. We're going to break that down today and compare it to some of the other data we had beforehand, and then we're going to think about what it means going forward. So let's get started. I think the most important thing to realize in the data world is no one data point can give you all the information. In the uncertain world we're living in, it seems like the data is increasing the uncertainty rather than neutralizing it. Conflicting data points seem to be the rule right now rather than the exception. Leading up to today, we've had lots of negative talk about the impact of tariffs, reducing immigration, and potential negative outcomes for the U.S. economy. But there was a lot of data that painted a positive picture. Prior to today, the labor market seemed very solid. The last report, we added 228,000 jobs. The latest CPI information, which came out just a few weeks ago, continued to show that prices were softening, which was leading us ever closer to the 2% target inflation rate that the Fed sets. Oil prices were falling. There were several economic statistics that were reasons to be optimistic. While on the other hand, we were concerned about the ultimate impact of tariffs. And we know that if we continue on this path to impose unreasonable tariffs on our trading partners, that will have a negative impact both in the short run and in the long run. And so we've been weighing these multiple concerns, some positive data versus what we know the effects of tariffs are. At the same time, we had reason for hope that the administration was going to pull back on its tariff policy, and that had led markets, which had nosedived throughout April, to regain much of the losses in the last week and a half. At the same time, Treasury yields had spiked, maxing out at about 4.5% on the 10-year Treasury. Those had come back down, and yesterday we hit as low as 4.1%. And so the data really seemed to be painting a more positive picture until this morning. And that's when the latest GDP report came out. The headline number was that GDP fell by 0.3%. It was expected to increase by 0.4%. So we fell well short of expectations. And most importantly, we actually saw a decline in real GDP. This follows a 2.4% increase in the final quarter of 2024. So that is a significant drop in economic activity over the last 3 months. Now, there are some reasons that we should not put too much weight on this number. But first, let's just talk about what the number represents. This is the GDP number from January 1st to March 31st. Remember Liberation Day, where Trump imposed a majority of his tariffs with the so-called reciprocal tariffs, which aren't really reciprocal in nature because they didn't make any sense. But the point is that we're looking at the period before the majority of the tariffs were in place. And so it's important that we account for that as we look at this data. So the headline number for this report was a fall, an actual decline in real GDP of 0.3%. This primarily reflected an increase in imports as importers tried to get ahead of the tariffs. So imports are subtracted from real GDP. So if you think about the calculation of GDP, it's consumption plus investment plus government spending and investment plus net exports. And net exports is just exports minus imports. And so if your imports increase, that's going to be a subtraction away from GDP. The idea, gross domestic product, is everything we produce in the United States. So exports would be a positive because we produce those goods, we just ship them to other countries. Consumption is a positive because we consume goods we make. But some consumption is imported from abroad. We don't want to count those goods as consumption that we produce because those are goods that were produced in another country. And so imports get subtracted out of the GDP calculation. So another way to think about these numbers is when you think about the total GDP number, if GDP is positive at 2.5%, when there's a large amount of imports, that's actually a good thing because that says you've produced 2.5% more than you did previously, but you've also been able to consume these goods from abroad. That's better than an economy that has 2.5% growth with no imports. That would say you produced the same amount, but you couldn't afford to buy goods from abroad that make you better off. So in the period January 1st to March 31st, imports increased dramatically, with net exports decreasing by about $162 billion. So when we subtract imports from GDP, that's going to cause GDP to go down. So when we think about this GDP report, real GDP fell by 0.3%. Net exports were down by 4.8 percentage points. So all of the reason that we're facing a negative GDP report is almost solely because imports went up so much. And imports went up a lot because people were trying to import consumption goods and intermediate production goods before the prices went up after the tariffs were in effect. The federal government also added to the decline in real GDP as the federal government spending declined by about 0.3 percentage points. And those were your two main factors that led to this 0.3% decline. On the other hand, inventories were up 2.3 percentage points. Business investment was up 1.3 percentage points. Consumer spending on services and goods were both up, although they increased at a decelerating rate. So while they were positive, they weren't up as much as they were in quarter 4 of 2024. And state and local government was slightly up by just 0.1 of a percentage point. What does this mean? It means we shouldn't put too much weight on the negative headline number for real GDP. Imports were very high in the first 3 months of this year as importers tried to avoid large tariffs moving forward. So they were going to stock up inventories. They were going to import as much as they could early before the tariffs took effect so that they would have those goods on hand. The implication is that moving forward, they're going to import less goods. So what can we expect moving forward? Well, next quarter, we can expect that imports will fall significantly, which will be a smaller subtraction from GDP. And so I would expect that in the second quarter, we'll see real GDP return to a positive number. And the question will just be, how large will that number be? And that'll depend on a couple of things. But let's keep in mind that the headline number of negative 0.3% real GDP growth is really showing more of the shift of imports into the first quarter. In the second quarter, we're going to see the opposite, and that should push the real GDP number up in the second quarter. But I don't expect real GDP to be negative 2 quarters in a row, at least not in quarters 1 and 2 of 2025. Whether it's negative beyond that point is going to depend on what the administration chooses to do with their tariff policy. Another way to think about it is we really want to look at a number that doesn't include exports and imports because we're going to get away from this. And they report a number like this. It's called the real final sales to private domestic purchasers. And this is just the sum of consumer spending and gross private fixed investment. When you look at that number, which is kind of like a core GDP number, so what's happening if we exclude some of the most volatile pieces of the GDP report, if we look at that, we see that quarter 1 real final sales to private domestic purchasers increased by 3%, which is relative to a 2.9% increase in quarter 4 24. There's actually been an improvement in the total sales to all private domestic purchasers. And so that should give us some comfort that the economy is still resilient. There's still a lot of positive economic momentum in the economy as we move forward. And it should help us to understand that the negative headline number is more of an anomaly than an actuality. Although it is important that we at least acknowledge that that number does show some weakening. How does that compare to the numbers I just talked about for the real final sales to private domestic purchases? So that number is slightly stronger in quarter one than it was in quarter four. But there's a reason for that as well. So again, we need to look back and forward. So in quarter four, 2024, business investment fell by 5.6%. To some extent, investment in quarter one of 2025 was fairly strong because it was just making up for a prior dip in investment at the end of last year. At the same time, remember, 40% of imports are intermediate inputs. So at the same time that we had a makeup for a relatively soft investment number at the end of 24, in the first quarter, we're also seeing businesses invest in new fixed investment in order to avoid the tariffs. And so we had a lot of investment shifted forward out of the second quarter and into the first. So we're going to see a weaker investment number in the second quarter than we see in the first. The private fixed investment was up almost 21% in the first quarter, which is relatively large if you look across data points over time for that number. So the real final sales to private domestic purchasers, it's the sum of consumer spending and gross private fixed investment. We know gross private fixed investment came in really strong in this report. On the other hand, consumer spending slowed. The increase in gross private fixed investment offset the slowing consumer spending, leading us to a number that is slightly higher than our quarter four number. If we look ahead, I expect that we're going to see more softening on the consumer spending number in the next quarter, and we're going to see a lot of softening on the private fixed investment number in the next quarter. That's going to lead to a private final sales number to private domestic purchasers that I think will come in substantially lower than what we're seeing right now. That will be the full softening of the economy. Now, all of this depends on what the administration chooses to do with its tariff policy. But to sum up the GDP portion of this report, I would say the negative 0.3% headline number isn't as negative as it seems. There are reasons we should have expected this number given the reactions to the Trump tariffs. Looking forward, it should give us great concern about where the economy is heading. While it's not as negative as the number appears, it is a warning shot across the U.S. economic bow that things aren't going as planned. The economy is softening, and we need to think about a new policy alternative to change course. Some supporting data on the weakening economy came from the ADP employment numbers this morning. They showed an increase in first quarter jobs of only 62,000, which confirms that there is this weakening in the economy. Now, the GDP report also produces a measure of inflation. That number is called the Personal Consumption Expenditures Price Index. It's an important number because it gives us an idea of what's happening in prices across the economy. And it's the preferred measure that the Fed likes to look at. While we're seeing weakening GDP, the worst case scenario would be to also see rising prices. Economists call that stagflation, when growth is falling and prices are rising. In the late 1970s, Reagan coined this relationship as the misery index. When the economy's weakening and unemployment is going up, and when inflation is going up, the sum of those two numbers is the misery index. What this report showed is that headline PCE inflation increased at an annualized rate of 3.6% in quarter one of 2025. That's up from 2.4% in the last quarter of last year. Core PCE inflation, so core is just the headline number excluding food and energy prices, which can be somewhat volatile. And we see that core PCE inflation rose at a 3.5% annualized rate in quarter one. which is greater than the consensus estimate of 3.1%. So we're seeing increasing inflation in this report. That's a problem. We have a softening economy, but we have strengthening inflation. Remember, the Fed has a dual mandate. They're supposed to try to target full employment. They're also supposed to target price stability. If you have an economy that's weakening and unemployment that's softening, but at the same time you have prices that are rising, the Fed is forced to choose one or the other. Do we target full employment and possibly let prices go out of control? Or do we focus on stable prices and allow the bottom to drop out in the employment market? That's the decision that the Fed is now faced with, at least possibly. Hopefully these numbers can turn around in the next report, but as of this time, they don't look great. As I mentioned earlier, there was a lot of positive economic data prior to today's report. The stock market had made a decent recovery. Bond yields, after spiking, had started to fall and had gotten back down to 4.1%, which was decent. And employment numbers have been relatively strong. But there's other data. We normally talk about that as hard data, so it's employment data. It's also backward-looking data. There's also data that's leading data. And what we've seen is while there's been some positive backward-looking data, the leading economic indicators have mostly been neutral or falling. Those are things like consumer expectations, business expectations, new orders, manufacturers' new orders for consumer goods and materials, building permits for new private housing units, and other indicators. Those indicators have been fairly soft over the last month. And so we continue to struggle with conflicting data. Some data saying, well, the economy is resilient and things are looking okay. We may be seeing some softening, but overall we're okay. The data this morning is a little more troublesome. It shows some significant softening. It shows the potential for actual declines in real GDP, i.e., moving into a recession, although it is by no means clear that we're absolutely going to move that direction, given that was mostly driven by import numbers. But it definitely is a sign that things aren't headed the right direction. So what does this all mean? Well, that's a hard question to answer. In and of itself, the economy is resilient. Policymakers layer on additional economic effects that can change the trend and the rate of growth of the economy. For example, under Biden, excessive federal stimulus was part of the reason we saw such high inflation. And while it propped up the economic numbers, it led to some negative effects. Under Trump, we're still seeing a resilient economy, but the tariff policies, the uncertainty, the day-to-day changes in the size of the tariffs, what's going to be tariffed, and what this new world order will look like has created tremendous uncertainty that's weighing on the resiliency of the economy. And we are now in this battle. It's who's going to win? Is the solid nature of the American economy, the strength of the American economy going to overcome bad policy, or is bad policy going to overcome the strength of the American economy? That will partly depend on policy decisions. How long before we get trade deals with our trading partners, especially India, Japan, the EU, Canada, Mexico? How long before we come to some agreement with China to bring down the absurd tariff levels that are falling on goods right now to a more reasonable and sustainable level, if you need them at all, in order to offset bad behavior and so forth that the administration has talked about? My overall point is that the American economy is strong, it's flexible, it's resilient. And if we could just have a baseline of decent policy below it, I think our future is bright. What concerns me is the administration's unwillingness to accept the signals the market keeps sending. The market keeps telling us tariffs are bad, let's move away from those. Yet, this morning, yet again, President Trump tweeted out right after this report came out that we are still in the Biden economy and that this report and the decline in the stock market was just an effect of the Biden economy, and that if we would just be patient and wait on tariffs to have their effects, everything would get better. That's the scariest data point of all. So to sum up, we're already seeing a lot of action in the economic numbers. But remember, these are all numbers from January to March 31st. They don't actually include the tariffs' real impacts at this time. Quarter 2 numbers will start to show the real impact of the tariffs, although we're going to have to decipher some weird movements in economic data across quarter 1 and quarter 2. But as we move forward, the signs are clear. The economy is softening while prices are rising. It's time to change course. It's time to move back to an economy where we focus on trade with our partners and focus on achieving sustainable fiscal policy. The Two-Handed Economist is produced by the Baker Institute for Public Policy at Rice University in Houston, Texas. Production support was provided by Karina Zamel, Shannon Moriarty, and Kevin Young. Be sure to visit us at bakerinstitute.org for more, and thank you for listening.